can somebody negotiate this? Mr. Limited Investor, they're coming up. You bring them a deal. It says 8 pref, 50-50 split. They're like, you know what, Joel? Not feeling that.
Yeah.
Can they do that?
They can do it. And here's how it would work. If, let's say that investor has a war chest of money.
There we go.
And they say, Joel, you know what? I got $100,000 for each one of these deals, but I'm kind of interested in more. I want a piece of the A shares. I don't want an 8 pref. I want a 10 or a 12 pref. So yeah, if you're it's like, and in order to get that, I'm going to commit $500,000 of equity to each deal. Okay, or $1 million in equity to each deal. So there's always a way for investors to get preferential treatment if they bring more value to the sponsor.
All right. Welcome back to How to Invest in Commercial Real Estate. We are here again. It is the end of the quarter. It is our favorite time, end of the first quarter 2022. Brian, why is this our favorite time?
Because it's distribution time.
That's why. Distribution time.
I was just signing checks today.
Ooh.
My favorite thing.
Nice.
A stack of checks. We may be up to 175 now, probably over $700,000.
175 checks that you send out?
Yes.
Wow.
That's a lot.
And I love it because they're people that I know, most of them, not all, people that I know that took a chance, invested on me, and they, maybe they're in multiple deals, and I just keep seeing their name, $1,000, $5,000, $10,000 checks, and that's a great thing. And that's really what we're selling here is, guys, get involved in commercial real estate because most people have never had an avenue to passive income in their lifetime. They only associate income with work. Or time.
That's how I was, for sure.
And so how much time does it take me? How hard is the work? What do I get paid for that work? And we want everyone to know there's a different way to do it. And it comes through passive income, through investing in assets. And in this case, real estate.
Yeah, the hardest you're going to work investing with us is listening to this podcast, figuring out the questions to ask us before you give us your money. Right?
Yeah, having to listen to us is the hardest part about making money with us.
Yeah.
So there's so many properties, there's so many different investors, and everyone really gets to look forward to these times. It's a group effort. It's you get your investment report for the property. You're looking over the financials for the property. You're seeing what leases need renewed. You're driving by them locally, and when you're cashing that check, it makes it so much easier than reading the report sometimes. If you're getting a bigger check than you've ever gotten on that deal, how's the deal doing? Mm-hmm. It's doing great. It's doing absolutely great.
So we thought we'd at least, and we've done it some before, but we think it's always valuable to talk about the returns investors get. How do they get those returns? What do the terms mean? And we say things like cash on cash, and we say things like preferred return, ROI, waterfall.
IRR.
What the heck is a waterfall, and why do I want it?
Yeah, and specifically, what is a preferred return, and why do you want that as an investor, right? So, as an example, if we raised $1 million, we probably bought big round numbers here, a $4 to $5 million deal is probably a $1 million equity raise. If we're raising $1 million and we have $100,000 in distributions that year we have $100,000 to kick out to our investors. We raised $1 million, so that's 10%. The investors get the first 8%. The first 8% always goes to the investors. We always put an 8%
and we call that
deal.
Call it what?
Preferred return.
Preferred return.
And a preferred return could be any number. We typically use 8, but I've seen 6. I've seen a bunch of numbers, but we typically use 8.
Yeah, so one of the biggest questions I get from prospective investors is, I'm going to give you $50,000, and how much do I own in this company? How much do I own? I'm like, I don't even know.
Yeah.
Why should you care?
Well, they might want to care, but that's a more sophisticated question. They think it's a simple question. It's a more sophisticated question because I may say, well, that $50,000 that buys you 3% of the deal or whatever. And like 3%, that's not a lot. But really, in order to understand if that's a good deal or not a good deal, you would have to be pretty sophisticated to understand what the equity structure is, how big the deal was, what the promote was. Where they're like, what is the promote? I don't even know what Joel's saying right now.
Yeah.
Okay, so that's why it's a sophisticated question. What's more is you should say, what's my preferred return?
Yeah.
And the reason you should ask that is because that's the money, that's the return on your investment you get before the sponsor takes any profit.
Exactly. So going back to our example here, we're distributing $100,000. Let's just say it's an 8 pref and a 50-50 split to make it super easy.
Yep.
Deal made 100,000. You raised $1 million. It's a 10% return. The investor's getting the first 8. So you've got 2% left over. So the sponsor gets 50% of the 2%, and you get 50% of the 2%. So you're each getting a point, right? So the investor gets 9.
9 points or 90,000 of the 100,000 cash flow.
Correct. And the sponsor gets 10.
So if someone comes and they say, "Hey guys, I want to syndicate a deal, and we're just going to do a straight ownership split, and you're going to take 60, and I'm going to take 40." Let's compare that to the pref scenario.
Yeah.
So we have 100,000 in cash flow in your example. If there's just a straight equity split between the sponsor 40% and the investor 60%, then out of that 100, the investor gets 60,000 and the sponsor gets 40,000. Mm-hmm. Really good for the sponsor. Okay for the investor. Mm-hmm. So how we're doing it, just so you know, is we do an 8 pref. So we're paying 8% before we take any money, and then, for example, we're splitting the difference. So yeah, now if $100,000 in cash flow, investors get 90,000 of it.
Yeah.
We only get 10 as the sponsor.
Yeah.
So I found a deal, I put it together, I managed it, and we worked the deal to the best of our ability, and then we generated $100,000 income. I only get to keep $10,000 of that. Mm-hmm. That's why a good preferred return protects the investor's investment.
Yeah. Okay, so what happens if you don't make the 8% preferred return in a given year? Does that carry over?
It depends. It depends on how the operating agreement is written. That would be an accruing preferred return,
so
which
sometimes
means
they
it would accrue over the calendar year.
Sometimes they accrue and sometimes they don't, right?
Correct.
I mean, it just depends.
Typically what we do is if it's a cash flow deal, we're not typically accruing year to year. And if it's a non-cash flow deal, let's say it's a development deal or something, and you're in it for 3 years, and yeah, we just accrue that 8%. We're not paying it.
Yeah.
But a sponsor can do it any way that they want.
Yeah.
Yeah. Prime example. We're building a building in Owasso. It has an accruing preferred return because, from the time you give the money, we have to go build the building for a year, and then we have to lease it up, and then we have to stabilize it. So, that return is accruing. I have a great question, which I get all the time. Why 8?
Why 8?
Why not 7, Joel? Why not 10, Brian? Why 8? Why are you giving me 8?
That's interesting that people ask that question a lot. I don't get it that much.
Yeah.
I think there's kind of an industry standard, and I would say it's 6 to 8.
Yeah, that's what I
typically.
But theoretically, what is the 8? What is the purpose of the 6 to 8? I mean, why is it that number?
Why is it that number? I mean, it's a number to me. It's a number that's well ahead of anything you could put your money in terms of just a savings account. Maybe it's somewhere around what you might get back on an average for investing in stocks.
Yeah, I think that's the case. Is you're trying to compete.
You're competing.
You're competing with other investments, and let's say the stock market average is 8 to 10% a year.
Yeah.
So then you're saying, hey guys, before I'm going to take a profit on the deal, I'm going to make sure I get you an equivalent return that you would get in the stock market, for example.
Yeah.
So you got 8%. Now, some people, they have let's say a downtown Dallas, super nice, brand new apartment complex. Well, that may only generate a 6 pref because the deal just has less return.
Right.
But you could argue that it's safer, it's newer, and so that may compensate for the lower return. Our deals, we've had a lot of success with investors getting comfortable with us saying, hey, we will pay you 8% before we take any money on this investment. They feel good about that. And then, hey, all I ask is that if I get you 8, anything over that number, we get to take a share of.
Yeah. I've seen some tiering even more than that, though. Sometimes can't you have okay, it's an 8% preferred return, and then there's another tier where, okay, now we're going to pay you and make sure you get a 12% IRR when we sell. And once we get over, well, maybe not when we sell, but at 12%, then the promote is say 20% or so. Then if you get to another guaranteed return, then you get another larger promote. Aren't there other tiers that can happen? Ours is pretty simple, but sometimes aren't there other tiers to try to incentivize the general partner to do better and better on the returns?
Yeah, so I love the way you worded that. It was, could you do that? Is there?
You can do anything, right?
You can do anything, and that's what I'm getting to here. Is in the operating agreement, we could write in that if the deal hits a 99% return, then we get everything over that.
Yeah,
you could write in that when you sell it, you get 10%.
I've seen sponsors that had a clause in there that basically they could buy out the investors at a 14 or an 18% return, they can just buy them out and they're just out.
Yeah, so
you really you need to read the agreement, right? And
you've got to read the
understand
agreement.
it.
And there's parts of the agreement that are boilerplated, copy and paste, like what are the risks during COVID, oh my gosh. They're obvious, but you need to go to the section. Ours is paragraph 4. It's section 4 every single time. You go to section 4, it says distributions, and it says A, here's what happens first. B, that's what happens second. If this happens, that happens. And you can read less than one page, and that's the legal binding rules. That's the operating agreement. That's the rules of the company that we're all legally bound to and signed up for. We have to follow that. And if we don't, we get sued to oblivion. It's not good.
Yeah. And to answer Brian's question about the tiering, that goes back to the term waterfall.
Yes.
So some people will use the term waterfall, and you kind of just imagine in your mind a waterfall that goes over one hump, which is the 8 pref. Then there's a certain split. And then you continue to cascade down the waterfall. If you get over 12% return, then the split goes from 60-40 to 50-50.
Yeah.
And then let's say you get them over 15%. To the investor, then it could switch, to a 40% investor, 60% sponsor.
Yeah.
And so that's what's the waterfall.
Yeah.
Is how what hurdles does the sponsor need to make, and how does the investor's return or their percentage of the return vary as those targets are hit?
Mm-hmm. I got a good one. I just thought of this. Can somebody negotiate this? Mr. Limited Investor, they're coming up. You bring him a deal. It says 8 pref, 50-50 split. And they're like, you know what, Joel? Not feeling that.
Yeah.
Can they do that?
They can do it. And here's how it would work. If, let's say that investor has a war chest of money.
There we go.
And they say, Joel, you know what? I got $100,000 for each one of these deals, but I'm kind of interested in more. I want a piece of the A shares. I don't want an 8 pref. I want a 10 or a 12 pref. So yeah, if you're say, in order to get that, I'm going to commit $500,000 of equity to each deal. Okay, or $1 million in equity to each deal. So there's always a way for investors to get preferential treatment if they bring more value to the sponsor. And it also depends on if the sponsor has the ability to raise the money. Let's say we got a big equity raise and it's $3 million and I've only raised $1 million so far and I'm kind of struggling. Yeah, I may have to increase the terms in order to solicit more investors.
And so that big investor, you'd have a different agreement with that person than you would the rest of the investors possibly?
You could, right? And I wasn't asking it to start a civil war and have all of my investors come to me and say, hey, Braden, I want to renegotiate.
Just so all our investors know, the answer is no when you try to...
What I would say is that in most circumstances, I'm going to try to avoid having 2 different return structures for investors.
It's kind of
it only creates animosity or jealousy or whatever. And I didn't get the best deal. Why did Joel give so and so a better deal? Yeah. So I don't want every investor to say, well, I've got to be the best negotiator and try to negotiate my prep. Yeah. What we try to do is find really good deals and pick a pref number, 8%, and a total return number, let's say 12% cash on cash, 20% IR, where the investors all feel good and they're not just trying to negotiate the heck out of the deal. Mm-hmm. And that I feel comfortable that I can go raise the amount of money I want to raise. So yes, everything's possible, but
I would say personally, if you want to take the whole deal, it's open for negotiation.
Yeah, right.
Like if we're raising $1 million and you say, hey, I love this deal, I can write that check. What does it look like if I'm buying the whole thing?
Yeah, we definitely can arrange something. Because why is that valuable to us? Right? Is that not only can I make my promote on that deal, but you say, well, I could have raised the money from other investors. Sure. But then by having his $1 million or her $1 million on that one deal, now I've kept that other powder from the other investors available for me to go buy more deals.
Plus, it's easier.
And so the more deals I buy, both the richer the investors get, but the richer we get.
Yeah.
And so anybody that provides us an opportunity to buy more deals is valuable. And so we can, hopefully give them some preferred return.
This is the perfect segue into something super exciting that we're going to work on the entire month of April. We will close it in the first week of May. It is a brand new deal we're launching in Slidell, Louisiana. And we're talking about adding value based on value added. And this is the perfect example. We have partners that we've done several deals with, and we're starting to both look at bigger and bigger deals as our comfort with raising equity and buying those bigger deals gets better. There's a big deal down in Slidell, and this.
Okay, can we tell people where the heck is Slidell? Because I'm already a pass.
Yeah,
it's north of New Orleans, right?
North of New Orleans.
Yeah,
it's like
north of New Orleans.
20 minutes.
I think it's just right across the lake from New Orleans. If I was looking at the map right,
that sounds better.
It's kind of a suburb, but there's that I don't know if it's Lake Pontchartrain or something. That's
I don't know. I know
right
there's
there.
a big river there and an ocean.
The demographics on paper.
Is there an
look
ocean
good.
there, Brian?
There's an ocean. That's great.
There's an ocean there somewhere.
And a river.
So the demographics look great. We're definitely going to fly
water.
down like we do every other deal. But the purpose of this is we're essentially taking this massive deal and we're chopping it in half. We're partnering up with another general partner who has the capability to get similar debt terms, who has the capability to get similar investors. And we're saying, hey, would I buy this at $13.5 million total cost? I don't know. It's a lot. It's a decent raise. Slidell again. And it changes your perception because you're thinking about it as $13 million when you really could think of it as, oh, we can just cut this in half. You do half of it. I'll do half of it. You guarantee half the debt. I'll guarantee half the debt. And then boom, you've got this massive deal that you essentially have mitigated your risk almost in half. I mean, you're still at risk of loss but not at the same amount of money.
For sure, there's the risk of loss is there. But yeah, what I like about it is now you've got two capable sponsors that have access to equity, access to tenants, all the experience, all working for the success of the deal. Instead of just having Braden and Brian and I working on the deal, now we've got us and we've got our partners out of Fort Worth all focused on the success of the deal. And we're both going to guarantee the debt. And both of our reputations are on this deal. So, yeah, I think it reduces the risk somewhat. It doesn't eliminate it, but to have more experience and more capital and more investors backing a deal, it's better.
Agree. We've got tons of closings in April. I think 3, maybe one's kicking into May. But the Kitty Academy Fund, we talked about that. That was filled up immediately. The St. Louis Fund, we closed on the first property of that already. It's doing incredible. The second one's going to close soon, but this deal is about to open. It's about to launch. It may have just launched if you're seeing this. It's only, I think, a $1.7, $1.8 million equity raise, exactly what the St. Louis Fund was, and that filled up in a week. So I'm telling you guys, if you want in, if you saw the last one, you're like, oh man, I missed. This is your opportunity. This is your chance. I don't know when there's going to be another one really soon.
We did have a lot of people who wanted to get in on that couldn't get in. So
at least, yeah, a lot. 6, 7 people, at least, just waiting on the sidelines for that deal. And this is an amazing deal. Tell us a little bit about the deal. Who's in it? I'll talk about the deal.
Yeah, you talk about your Slidell deal.
So it's
what do you mean? Who's in it? I didn't know what.
Who's in it. Well, I'm in. I don't know.
I didn't know what that question
Woodmont's
meant.
in.
So the deal is a community shopping center in Slidell. It's shadow anchored by a Walmart super center, a Sam's Club. There's a brand new Aldi's next door. But it's funny, when you look at the map of this retail corridor, you've got shopping centers behind and you've got pad sites up front. Shopping centers behind, pad sites up front. We had Grant on from the Woodmont Company, our partner on this deal, on the podcast. I don't know what episode it is, but we'll plug it in somewhere. And the premise of the show was that there's so much over parking. If you just carve off little pads and sell it to a Taco Bell or KFC or a Logan's Roadhouse or whatever, those are $1 million bills just sitting there. And you can probably have 3 of them on this site. And this is the only site in the corridor that hasn't sold their pads. So when you look at it from that perspective, you're going to see, oh, this is a no-brainer. But a bunch of other people didn't look at it from that perspective. They're trying to underwrite this 8-cap shopping center that they're not in love with. And we see it as an 8-cap shopping center on the downside.
Yeah, with upside.
But the upside is these $3 million bills sitting here, pad sites that you're going to offload and sell. So it's a great little deal. We believe in it. We're going to be investing in it. We're going to be guaranteeing the debt.
So let's let them know, what is the cash on cash expectation?
Expectation, the first year, 11%. It goes up pretty significantly from there with the pad site sales.
Okay, 11%. And so just to remind everybody, because we don't know what people know about cash on cash and preferred return. We've talked about the preferred return. That's what you get before the sponsor takes the split.
Yep.
The cash on cash is what the investor makes on their cash invested in a year.
Correct.
So 8% preferred return on this deal. Is that what we're paying?
Correct.
Okay. So then the deal level cash flow must be 14, 15%. Because you give the investors the first 8.
70-30 split on the back end.
Yep. Okay. And then 70% of whatever's left goes to the investor after the 8. So yeah, it probably does then 16.
Yeah, and then
they're getting 11%. Yeah, it's probably 14, 15% total cash on cash, 11 to the investor.
And how we structure it and how it aggressively gets up is we start underwriting pad site sales in year 2, pad site sale, year 3, pad site sale, year 4, pad site sale. There's 3. Stagger them 1 per year starting in year 2. And what we're doing with the funds from that, the bank isn't requiring any release of or principal pay down to release those pads, which I will tell you does not happen very often. Great negotiating point from our partners. So we're going to take that money. The first one's $1 million. And we're going to distribute, we're going to pay the equity back with 90% of that. Sponsor gets 10% of that. So now your equity balance, that 1.8, has been reduced almost by half from that first pad site sale. So now you're 11% cash on cash, even if you're receiving the same cash dollar amount. Let's say you received $100,000 and that got you to 11%. Well, now your $100,000 is going to get you 16. It's going to get you 14, 15 because we paid a big chunk of your capital back. Same thing with the rest of the pad site sales. And then eventually you've got hardly
what IRR are we pitching?
22.09. And a
5-year?
5-year and a 2.05 equity multiple. It could easily be done in 3, again, 5-year deal, 5-year debt.
Yep.
6 months interest only to go in and stabilize the deal, put our management in place. And yeah, I think it's going to be a great little deal.
All right, what else do we want to say on preferred returns? It's, once again, the end of the quarter. We're paying the distributions. If you want to get checks in the mail, hit us up. Let's get you invested in a deal.
Yeah. The best way to do that is to go to the website, howtoinvestinCRE.tv, which isn't anything to do with TV. It has to do with Tel Aviv. Don't even know. Please cut that out. The first one is howtoinvestinCRE.tv. And the next one is our website, the Criterion. Fuck! If you want to get on our Can you do this?
Yeah. So what's the best way that someone can find out about this deal once it launches?
Go to our website, howtoinvestinCRE.tv, hit join our investor list. It asks for your first name, last name, email address, and if you're accredited, which isn't even required, you hit submit. Boom! You're on the email list. We're going to send it out probably 2 days before you saw it, and you're going to get it.
All right. We have lost Braden.
Thanks, everybody.
Well, make sure to like and subscribe and share with your friends. If you've got a topic for the next episode, send us a DM, send us a message, and we will cover it next week on how to invest in commercial real estate.
All right. Check you guys next week.